Your first $100 won't make you rich, but it could change your financial future forever.
The biggest investing mistake isn't buying the wrong stock. It's waiting too long to start. The cage racing for the resings.
The biggest investing mistake beginners make. Now here's where things get interesting. Imagine you've finally decided to invest. You open your account. You buy your very first investment. And then, a week later the market drops. 5%. Then 10. Maybe even 20. Almost instantly, your brain starts asking questions. Did I make a mistake? Should I sell before it gets worse? Maybe investing just isn't for me. This is the moment where many beginners make the biggest emotional mistake of all. They confuse temporary losses with permanent failure. But markets have always moved in cycles. They rise. They fall. They recover. And then they grow again. That's simply how investing works. Think about the weather. Just because it's raining today doesn't mean summer has disappeared forever. The stock market behaves in a surprisingly similar way. Storms always feel permanent while you're standing in them. But eventually, the sun comes back. History has shown this over and over again. The people who usually build the most wealth aren't the ones who perfectly predict every market move. They're the ones who stay invested long enough to benefit from recovery. That sounds simple, but emotionally, it's incredibly difficult. Because your brain is designed to avoid pain. When you see red numbers on your screen, your instincts tell you to run. Unfortunately, successful investing often requires doing the opposite of what your emotions suggest. That's why experienced investors rely on systems instead of feelings. One of the simplest systems is investing a fixed amount every month. Whether the market is up, or down, or somewhere in between, you continue investing. This strategy removes the pressure of trying to perfectly time the market. Because honestly, almost nobody can do that consistently. Even professional fund managers struggle to predict short-term market movements. So why should beginners expect themselves to? Instead of asking, is today the perfect day to invest? Try asking, will this investment likely be worth more in 10 or 20 years? That's a much better question. Long-term thinking changes everything. Another mistake beginners make is constantly checking their portfolio. Some people open their investment app 5, 10, even 20 times every single day. Imagine planting a tree and digging it up every morning just to check whether the roots are growing. Sounds ridiculous, right? Yet many investors do exactly that with their money. Constant checking creates unnecessary stress. It encourages emotional decisions. And emotional investing rarely leads to good results. The truth is, most wealth is built quietly, without excitement, without headlines, without viral social media posts. It's built through boring consistency. Month after month, year after year, one investment at a time. Eventually, something amazing happens. Your returns begin earning returns. Then those returns earn even more returns. That's the magic of compounding. At first, progress feels painfully slow. Then, almost without noticing, growth starts accelerating. It's like pushing a giant snowball down a hill. The first few feet require the most effort. But eventually, the snowball becomes so large that momentum takes over. Money works the same way. The hardest part isn't growing wealth. It's getting started. That's why the first $1,000 often feels harder than the next 10,000. Not because the math changes. Because your habits change. Your confidence grows. Your understanding improves. And investing slowly becomes part of who you are. Financial freedom doesn't usually arrive through one lucky investment. It arrives through hundreds of ordinary decisions repeated consistently over many years. Skip unnecessary purchases. Invest regularly. Ignore short-term noise. Stay patient. Repeat. It sounds almost too simple. But simple doesn't mean easy. If it were easy, everyone would be financially independent. The reality is, Most people quit just before they begin seeing meaningful results. Don't let that be you. Start where you are. Invest what you can. Stay consistent. And most importantly, give your money time to do what it does best. Grow. Because years from now, you probably won't remember the exact day you made your first investment. But you'll definitely appreciate the decision you made. Your future self will look back and realize that the biggest investing mistake wasn't choosing the wrong stock. It would have been never starting at all. So if there's one lesson to remember from today's video, it's this. Don't wait until you feel ready. Start small. Stay consistent. Trust the process. And let time become your greatest financial advantage. If you enjoyed this video, consider subscribing for more practical personal finance and investing content every week. Until next time, keep investing in your future. Because one day, your future will thank you for the choices you make today. Thanks for watching my video. Subscribe now. The biggest investing mistake beginners make. Have you ever looked at the stock market and thought, maybe I should start investing, but what if I lose everything? If you have, you're definitely not alone. In fact, that's exactly where millions of people get stuck. They spend weeks watching videos, reading articles, asking friends for advice, and scrolling through social media looking for the perfect investment. But here's the strange part. The biggest investing mistake beginners make isn't buying the wrong stock. It isn't choosing the wrong ETF. It isn't even investing during a market crash. The biggest mistake happens long before any money is invested. It's waiting. And honestly, that's something I spent way too much time thinking about. My name is Nick, and I love understanding why some people quietly build wealth over decades while others stay trapped in the same financial situation year after year. It's fascinating because most of the time the difference isn't intelligence, it isn't income, and it certainly isn't luck. It's behavior. Imagine two people. Both are 25 years old. Both earn the exact same salary. Both dream about becoming financially free. The first person starts investing $300 every month today. The second person keeps saying, I'll start next year. Then next year becomes the year after that. And before they realize it, 5 years are gone. Nothing dramatic happened. No big financial disaster. Just delay after delay. That doesn't sound like a huge mistake. But financially, it's one of the most expensive decisions a person can make. Because investing isn't only about money. It's about time. Time is the one thing you can never buy back. Think of investing like planting a tree. Most beginners stare at the tiny seed and think, really, that's it? They expect instant results. Instead, weeks pass. Nothing happens. Months pass. Still nothing exciting. Underground, though, the roots are growing. And that's exactly how investing works. For a long time, it feels like nothing is happening. Your account grows slowly. Your returns look small. Your friends might even laugh. Social media certainly won't make you feel patient. Every day you'll see someone claiming they doubled their money overnight. Someone else bought cryptocurrency at exactly the right time. Another person supposedly turned $500 into $50,000. Honestly, most of those stories are either incredibly rare or completely exaggerated. But beginners compare themselves anyway. That's mistake number 2. Comparing your chapter 1 to someone else's chapter 20. We almost never see the years they spent learning, the mistakes they made, the money they lost, the sacrifices nobody posted online. We only see the highlight reel. And that's dangerous. Because comparison creates impatience. Impatience creates emotional decisions. And emotional decisions usually create financial losses. The market doesn't reward excitement. It rewards consistency. That's not a very exciting sentence. But it's true. Imagine you started investing today. Your first month, your account goes up $18. The second month, maybe it's down $27. The third month, up again. Nothing spectacular. Honestly, it almost feels boring. But that's exactly what long-term investing is supposed to feel like. If investing feels like a roller coaster every single day, you're probably doing something wrong. Successful investing is surprisingly ordinary. It's repeating small decisions again and again and again until those small decisions become something much bigger. Think about brushing your teeth. Skipping one day doesn't seem important, but skipping every day, now the consequences become obvious. Investing works almost the same way. One missed month doesn't ruin your future, but years without investing, that's where the real damage happens. Here's another mistake beginners make. They believe they need thousands of dollars before they can begin. That's simply not true. Some of today's most successful investors started with surprisingly small amounts. Not because small amounts make people rich overnight, but because small habits grow into big habits. Someone investing $100 every month is building something much more valuable than money. They're building discipline. And discipline compounds just like investments do. That's something people rarely talk about. Money grows. Confidence grows. Knowledge grows. Experience grows. Everything compounds. That's why your first investment is often the hardest. Not because it's expensive. Because it's emotional. Once you've crossed that line, everything starts feeling different. You stop seeing money as something you spend.